Okay, let's be honest. Is looking at your portfolio right now giving you a bit of a heart attack every time you open it? Yeah, you're definitely not alone. The market feels incredibly shaky and that nervous energy is just everywhere. So in this explainer, we're going to cut through all that noise, look at what the data is actually telling us, and figure out if it's really time to panic or maybe find some perspective. So this is the big one, right? The question that's just lighting up every investing forum, every group chat. Are we actually in a crash? It sounds like a simple question, but the answer, well, it's a little more complicated. Let's break it down. And man, this quote just nails the mood, doesn't it? The dread is so thick you can practically feel it. You've got major indicators like the Fear and Greed Index just flashing bright red, and people are starting to throw around the year that still gives investors nightmares, 2008. And this right here, this gets to a really crucial divide. You know, the big indexes might only be down a few percentage points, but for anyone holding individual stocks, especially some of those high-flying tech names, their portfolio looks exactly like this. The pain isn't some abstract idea. It's very real and it's very personal. I mean, this analogy is just perfect. It's not that the market is definitely crashing, but it feels like the road is icy, it's foggy, and maybe everyone's had a few too many. The warning signs are flashing everywhere, creating this deep, profound unease that, we might not make it home in one piece. All right, so we've established the panic. It's real. Now let's switch gears from emotion to evidence. How does Wall Street actually define these downturns? Because putting the right name to the pain is really the first step to understanding what's going on. So let's get really specific here. The first term you gotta know is a market correction. And this isn't just a feeling, it's a technical definition. It means a drop of 10% up to 20% from a recent high. It hurts, for sure, but it is absolutely not the same thing as a full-blown crash. And this is where things get really important. A correction is a sharp, painful dip that can happen even in a healthy, growing market. A bear market, on the other hand, is a completely different animal. That's a deep, sustained drop of over 20% that usually signals a major storm is brewing in the economy. So, what's the actual reality right now? After all the talk of 2008 and motorcycle accidents, where are we really? Well, get this. The S&P 500 is actually down just 3.6% from its peak. That doesn't even qualify as a pullback, let alone a correction. There is a massive gap between the fear we're all feeling and the numbers we're actually seeing. Okay, so let's pull back for a second. Let's zoom out. Every single market dip feels like the end of the world when you're living through it. But history shows us that there are patterns. So what can the past teach us about moments that feel just like this one? Now this chart is absolutely fascinating. Just look at it. Along the bottom you have the worst drop during a given year, and then you see how the year actually ended. Look how many of those dots are in the top half. Since 1950, even in years with scary double-digit drops, the market still finished positive 73% of the time. This kind of volatility, it's not just common, it's completely normal. I mean, just let that sink in for a minute. Since 1928, the market has had a correction, a drop of 10% or more, about once every 1.1 years. These aren't some rare black swan events. They are a regular, almost predictable feature of being an investor. And what happens after the storm passes? Well, the rebound is often incredibly swift and powerful. This chart shows that just 12 months after a correction hits its bottom, the market is historically up nearly 30% on average. That right there is the staggering cost of panic selling. Okay, so if these pullbacks are totally normal, and they're often followed by strong rebounds, why does this one feel so different, so incredibly tense? Well, it pretty much all comes down to two little letters, AI. You're looking at two lines here that just love to dance together, economic uncertainty and market fear. When one goes up, the other usually follows right behind it. And right now, the single biggest question mark hanging over the entire economy is the AI boom. The market has placed a multi-trillion-dollar bet on AI, and now everyone is getting nervous about whether that bet is actually going to pay off. Yeah, the entire AI trade is officially under the microscope. Tech giants are spending billions, often with borrowed money, to build out all this infrastructure. The question is no longer, is this stuff cool? Now it's, can this actually make money? And all of that anxiety, all of that pressure is now focused on one single event, Nvidia's upcoming earnings report, which has basically become the final exam for the entire industry. And as this user so colorfully puts it, the expectations for Nvidia aren't just high, they're astronomical. A good report isn't going to cut it. It has to be outrageously, unbelievably good. Anything less risks confirming the market's worst fear, that we're all just suffering from AI fatigue. All right, so we've got the fear, we've got the facts, we've got the history, and this huge high-stakes AI bet. So what does all this mean for you? What should you actually be focusing on? Well, the answer might be a lot closer to home than you think. And this is probably the most important truth of all this. Shaky markets aren't a test of the economy. They're a test of your plan. A small dip feels like an absolute catastrophe when you've taken on way more risk than you can actually stomach. And it reveals every single crack in your personal strategy. And listen to this, because it's just simple, powerful wisdom from someone who's clearly been through this before. The biggest losses, they often don't come from the market downturns themselves. They come from the emotional, fear-driven decisions we make right in the middle of them. So what's the playbook here? How do you actually navigate this stuff? It really boils down to a simple, three-part game plan that you have to build for yourself. First, you have to truly know your own stomach for risk before things go south. Second, you build your strategy when you're calm, not in the middle of a storm. And third, and this is the hardest part, you use that plan like a shield to ignore the noise and the panic. And really, that's the ultimate question this moment is asking every single one of us. When things get shaky, what's in the driver's seat? Is it a plan or is it panic?